Looking for strategies to help you protect your portfolio in these uncertain times? Visit robblack.com. robblack.com, powered by EP Wealth.
Thanks for listening to the show. May 4th. May the 4th be with you. S&P 500's up fractions. The Nasdaq's down 0.33%. Markets are struggling to get some direction up today. Dow Jones Industrial Average down 80 basis points to 49,105. The Russell 2000 at all-time highs, record up fractionally, just 0.1%. Gold sits at $45.81 an ounce. That's down 1.3%. Bitcoin sits up $1,067 to $79,724, just short of 80,000. Crude oil up 0.2%, $102.58. Take a look at some treasuries. Let's see how we're doing on the 10-year. That's the one that I'm most attracted to. Although the 2-year also gives you some ideas on current market conditions and expectations. 10-year sits at 4.43%. Still pays to stay in cash, as that beats inflation, which is a lot of people's biggest concerns, especially in retirement. Taking a look at some of the big stories or headlines that jump out instantly to me. Obviously, Iran's still not finished. And there was news that maybe 2 missiles hit U.S. ships, warships, near the Strait of Hormuz. The United States says that's not true. It has not been confirmed by independent sources. Interesting to note. So oil is rising on the signs of Hormuz higher tensions. Gold is following it as traders assess the Hormuz tensions and inflation risks on a daily basis. NVIDIA's Jensen Huang says that NVIDIA now has zero market share in China. NVIDIA down 1.4% today, AMD down 5.6%. They report this week. It is noted that AMD is facing chip shortages. Everyone can sell more chips right now. It's just the supply chain is a little on the full capacity side. So much demand at this point in time. Spirit Airlines says it had no choice but to liquidate operations. This is one of those business stories of the day because it hurts people. Approximately 9,000 flights from May 2nd through the end of the month are affected. 34-year-old budget airline closed Saturday morning. If you paid by credit card, you can file a chargeback. If you pay by cash or debit, you become an unsecured creditor in bankruptcy. You may get refunded, but it could take months or you might get pennies on the dollar. So what we need to learn from that is use your credit cards, people. Don't use debit cards. Anytime I'm at a grocery store or a restaurant and I see someone pay with debit, I'm like, if you drop that on the ground, I can instantly wipe out your account because I just saw your PIN number maybe. Now, I don't want to get too much into that, but PIN numbers aren't the hardest things to break. Just saying. And since a lot of people use the same pins through the years, they're not the toughest information to get on the dark web. I would never, ever, ever dream of putting a debit card in my wallet. So back to Spirit Airlines, 17,000 workers lost their jobs. The good news is for the pilots and the mechanics, not necessarily for the baggage people. For the pilots, there is high demand in the industry, as with mechanics as well. Back in the day, Spirit's fares were so low that they set up a bottom for airlines on what they could charge. United would look at Spirit and say, okay, we'll do a little bit more than that because we're considered better service. But since only 1.1% of their flights, since they only operate 1.1% of the United States domestic flights, that tether between being the lowest fare and keeping the other airlines honest really wasn't there in the first place. Didn't think I'd be doing a story on Spirit this morning, did you? Year to date, crude oil's up 78%, silver's up 8%, gold up 7.6%, Bitcoin's still down 11%. The all-world Morgan Stanley Country Index up 6.44. That's better than the Dow Jones Industrial Average up 2.3%. It's also better than the S&P 500 up 5.4%. There's no shame owning international stocks. NASDAQ is up 8% on strength of technology in the month of April. Russell 2000 up 12%. and that's at an all-time high. The Magnificent Seven as a group is only up 2.3%. So coming into May, the stock market is red hot. And it brings into the question that we get every year, do I sell in May and go away? Basically coming back for the fall months as volume drops in the summer times as bankers go on vacation. I don't think that's as much of a story as it used to be. Technically, the May is the fourth weakest month of the year. Historically, it also kicks off a stretch of seasonality that bankers go on vacation. I go on vacation. Dating back to 1945, the S&P 500 averages just 2% gain from May to October. Considered weak compared to the S&P 500, typically returning 7% from November to April. In the past 10 years, stocks have gained during this stretch, and 2025 brought the strongest sell in May cycle on record. But that was also tied towards tariffs. The strong start to 2026 gives reason to doubt a sudden reversal. Earnings are doing great. Stocks continue to smash records despite the Iran conflict, elevated oil prices. The elevated oil prices gives us fears of rising inflation fears. Changing the guard at the Federal Reserve brings up question marks, but probably stock market catalyst, as Warsh is considered to be interested in cutting interest rates day one. Overall, the S&P 500 has been positive in May, 12 of the last 13 years, positive in June, 9 of the last 10 years, positive in July, 11 consecutive years. Seems to me like you should stay invested. If history is your guiding light post in investing, earnings have been crushing it. Big old profit margins, which we're talking a lot about now going forward as the thing that can keep the stock market moving higher. It's not the best way of saying that. Oh, I've got a fun story about Amazon coming up. Keep in mind that last week, Fed Chairman Jerome Powell spoke about the resiliency of the economy and the labor market. So we're going to watch Friday's labor report as very important. Chevron's price target was lifted to $192 from $180. Interesting. Obviously, with a higher price of oil this quarter, it was disrupted in the first quarter, which showed some problems for Chevron's earnings as well as Exxon's, but there won't be a disruption. There'll be a drift lower maybe in the second quarter. GameStop made an unsolicited, non-binding offer to acquire eBay for $125 a share in cash and stock. No one thinks this deal is going to go through. GameStop would have to issue shares. They'd have to raise the money. And in theory, there's a lot of money out there. Why aren't they doing it? The Warren Buffett Berkshire Hathaway annual meeting got put to the test this weekend. One of the things he's said in interviews over the weekend, that the casino has gotten very attractive to people, talking about the S&P 500. And he says, if you're buying one-day options or selling them, that's not investing. It's not even speculating. It's gambling. I don't know anyone who does one-day options, but the idea does sound like fun, just not wise. American Express monetized their investments in the Global Business Travel Group as part of a broader take-private transaction by Long Lake Management, making a significant capital allocation shift. Sometimes you have to read these financial reports really slowly as you're learning new terms. Importantly, the strategic partnership with American Express and GPTG, which operates American Express Global Business Travel, is expected to remain intact, preserving commercial synergies despite the ownership exit. The timing of the transaction is notable, coming alongside CPTG's strong results. The strength likely helped support the premium valuation secured in the deal. For American Express, the exit represents a clean monetization of a legacy investment at an attractive price, while aligning its strategy of prioritizing high-return core operations over minority holdings. It's one of those financial transactions that you really don't see coming. A lot of the reasons I take a look at cruise lines, I want to see how consumer sentiment's holding up. Are we putting our money where our mouth is? Are we booking cruises as they're getting more expensive with higher fuel costs? With banks, they tell us how their credit cards are doing. With credit card companies like American Express, they tell us how the consumer is doing as well. This is one of those, I don't own American Express directly. It's a play on small business, and it's a play on travel-related perks. It seems to make a lot of sense. Elsewhere in the news, Airbnb was upgraded to buy from hold over at Oppenheimer. Analysts said that products like initiatives tied towards AI search in hotels are not yet fully reflected in Wall Street expectations. This was a stock that I think is overly, how shall we say, an underperformer in the last 5 years. It seems that getting you and I to go on vacation in other people's homes would be wildly profitable for a company that doesn't own said homes. And it is wildly profitable. They just haven't gotten enough traction and the ability to attract me. I'm not going out right now in the last 3 years and buying a home and saying, oh, I'll give it to Airbnb to rent out for me. The cost of the home, the getting in, has been painful. So Airbnb needs people to get into more affordable homes so that they put their homes up. Do you see where we're going with this? That's just one of their things. Well, one of their problems, if you will. This will be a good quarter for them. They're trying to monetize their experiences, and they got the World Cup. Demand for rentals in host cities is increasing. Management's fixes are doing well. So I would expect Airbnb to travel up to 150, 160 by the end of the year. It's one of those stocks that I think you can trade. They're not going to go out of business. They're heavily tied towards housing, but also vacations. I will never, ever. Now I'm too old at this point in time. But when my family was from the age of essentially 0 to 18, I would much rather stay in an Airbnb than put a family of 4 in 2 hotel rooms. My kids, when they turn 13, 14, 15, they're 6'3". They're big boys. They don't want to lay in a bed next to each other or next to their mother. So Airbnb makes a lot of sense. But now that my kids are getting out of the house, they're not there yet. They're still in high school. But in the next couple of years, they will be. And when they do, maybe I'll only Airbnb when we go on family vacations, when they have families. But I have to imagine from 18 to 25, they're going to be hanging out with their friends. And I'll have to wait those 7 years to get my kids back until they have kids. And maybe not, but you see where I'm going with Airbnb? You can develop some thesis on your own. I know you can. Let's take a break here, but when we come back, we'll talk about semiconductors. We'll talk about software. We'll talk about the Magnificent Seven, SanDisk, Alphabet. Amazon's got a great story today. Got a big event coming up a couple Saturdays from now. It's a Pints and Portfolio. It's in San Mateo. It's from 11 a.m. to 1 p.m. It seats about 10 people total. We take over a big table at a brewery. I bring a couple financial planners. We get to know each other, talk about financial planning, talk about, are you only in tech stocks, diversification, what products do you have, what products do you not have, what products should you have. You can sign up at robblackshow.com. That's robblackshow.com. That's coming up on the 16th of May.
The markets are more volatile than ever. Inflation, interest rates, global uncertainty. If you have $500,000 or more invested, ignoring it could cost you your future. At EP Wealth Management, they offer a free preliminary financial plan, a chance to identify potential risks in your portfolio before the next downturn hits. Get insights from Chad Burton, CFP, and Rob Black, trusted voices in financial planning and retirement strategies. They'll help you spot hidden risks, rebalance thoughtfully, and uncover opportunities to grow and protect your wealth, even in turbulent times. Their goal? To help you feel more confident about your financial future during uncertain times. Don't wait for the markets to decide your future. Schedule your complimentary preliminary financial plan at robblackshow.com. That's robblackshow.com. EP Wealth Management. Plan smarter, live better, no matter what the markets do. Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.
Take-Two. They are a software video game company. Their stock is climbing today 4% on news that Bank of America said that Grand Theft Auto 6 will likely come with an $80 price tag. Plus, they're going to sell billions and billions and billions more in add-ons for the game, as they've done with the last 13 years with Grand Theft Auto, the last installment of it, 5. Demand's going to be huge. My kid's been playing it for 8 years or so, since the pandemic. right before the pandemic, and he spent hundreds of dollars during the pandemic on add-ons for a game. It's one of the biggest, if not the biggest, entertainment title ever. It's definitely in the video games, and you can compare their billions and billions of dollars that they've earned to the movie industry, and it thumps it. So Bank of America says that Grand Theft Auto is going to come out $80 price tag. Shares of Take-Two are up about 4%. It's probably going to come out this fall, is the thought, unless something happens last second. Now, it's been delayed so many times. The $80 price point for the year's biggest game would further usher in the higher industry price ceiling, which climbed to $70 around 2020, following 15 years at the $60 level. So there is inflation in video games, and you can see it. So investors will be paying real close attention to Take-Two's earnings call later this month for any official Grand Theft Auto pricing and confirmation of its November release date. Stocks have sunk a little bit more as the morning has gone on. A little sad, but there's a lot going on in the Strait of Hormuz, and the president's going to be visiting China, and China's saying, ignore American sanctions. There's not a lot going well in this administration at this point in time. Now, again, it's been a tumultuous second term for Wall Street and how they deal with Trump announcements on Truth Social, with tariffs being big splashy things almost on a regular daily basis in his administration. It's a lot of work to keep up on top of this market. Norwegian Cruise Lines, their stock is getting hit today. Europe headwinds hit their outlook. I look at cruise lines to figure out what's going on with consumers. Are they excited to travel? Cruises are considered to be cheaper than staying in hotels and flying because it's a floating hotel. So the sharp cut to 2026 guidance is driven primarily by declining net yields, reflecting geopolitical disruptions, particularly in Europe, as well as internal missteps in marketing and revenue management. The company is aggressively reducing costs with $125 million in structural savings, much of that benefits being offset by higher fuel and logistical expenses. So Norwegian Cruise Lines emphasized that this is a turnaround story with execution, not brand health, the core issue. Now, their struggles is pulling down Carnival down 2.5% today and Royal Caribbean down 1.3%. Separately, 3 people have died and at least 3 others are sick after a suspected outbreak of the hantavirus, which is brought about by rodents on the cruise ship sailing in the Atlantic Ocean. The World Health Organization said this announcement because it's obviously a boat that needs to be rescued at this point in time. And those kind of stories tell me I'm not going to go on a cruise anytime soon. Bernstein raised their price target on digital memory stock SanDisk today to $1,700 from $1,250 after last week's strong beat and raise. Strong, very strong. They've said we're negotiating higher deals each year for the next 3 years. We're sold out. HSBC downgraded chipmaker AMD from buy to hold today, citing limited upside. They're going to report numbers this week. So this quarter, what we learned last week, coming out of the earnings from the 4 of the big AI companies, Amazon, Meta, Microsoft, somewhat you would say Apple as well. What we learned coming out of the big earnings last week was that companies that have spent are big winners. Companies that continue to spend are getting big returns, more than people thought possible. Citizens hiked the Google's price target to $515 from $385. That's a big hike because they had a great quarter. They reported earnings nearly double the street's expectations. Shares jumped after management said to expect higher CapEx spending in the year ahead. Companies that are investing in AI are getting rewarded, and the rest of the companies in the world will be rewarded in the future due to using said AI to improve their profit margins, even 2 or 3% changes the valuations majorly for companies and for indices. Now, here's an example of AI and how it's disrupting an industry. Some trucking logistics stocks are lower today after Amazon announced the launch of Amazon Supply Chain Services. This extends the company's entire portfolio of freight, distribution, fulfillment, and parcel shipping solutions to businesses of all types and sizes. Basically, Amazon is now offering to handle the entire shipping process for other businesses, not just its own packages. So companies are getting whacked today. GXO Logistics, ticker symbol GXO, is down 11%. UPS, down 8.8%. C.H. Robinson, down 8.6%. FedEx, down 8.5%. Expeditors International, ticker symbol EXPD, down 7.2%. SAIA, down 4.6%. JB Hunt Transport, down 3.6%. Knight Swift, big trucking company, ticker symbol KNX, down 3.3%. So let me explain this in my terms, because when you read the press release, it's a little harsh. But Amazon unveiled Supply Chain Services, which is a new business that turns the vast warehousing and logistical networks behind its e-commerce empire into a product for other companies. An Amazon Web Services style move applied to the physical world. As Amazon put it in their press release, any business can now move, store, and deliver everything from raw materials to finished products using the same supply chain that supports Amazon and its independent selling partners. This could make Amazon's behind the scenes being an operator for others in even a wider swath of commerce. The notes that I saw today show that it expanded its reach beyond its marketplace and helping it capture more of the $1.3 trillion third-party logistics market. FedEx stock was down, as was UPS. So Amazon has grown. Amazon has built out its logistics capabilities, internalizing some of the shipping needs and offering services to its third-party sellers. It's a competitive threat for FedEx and UPS. Amazon has a history of disruption. This story may sound familiar. Amazon built another major offering, cloud infrastructure, for the same reason, to run its own business better. And then it started selling it. That's how Amazon Web Services was born and how it's transformed how the world builds and runs software. Amazon is ready to do the same thing for supply chains. So Amazon's ready to do for the supply chain what it did for cloud infrastructure. There was no FedEx of the cloud before Amazon jumped in. Shipping is more mature now. Historically, there have been enough growth for logistics providers, including FedEx, even as large organizations such as Walmart and Amazon have adopted their own logistics strategies. I remember back in the 1990s following FedEx and UPS and saying, these are tech companies because of their logistics. The United States Postal Service and Amazon are also ran into some issues with pricing. FedEx is doing business again with Amazon after walking away in 2019. All that is happening is investors expect a shipping volume rebound in 2026 following a brutal 3-year post-COVID freight recession. The App Store revenue growth is accelerating. China returns to growth. Bank of America talks about the App Store revenues in the third quarter of 2026. After 33 days so far, have increased to $3.2 billion, up 3.7% year over year. Total downloads on the iPhone and iPad were 0.7% higher year over year. App Store dollars per download increased by $1.01, up 3% year over year. So Bank of America reiterated their strong buy on strong capital returns, eventually the winner in AI at the edge and optionality from new products. They see the stock hitting $330 this year. Alphabet, the stock remains JP Morgan's top overall pick. Interesting. This was my top pick last year. The stock has climbed 23% this year and 135% in the last 12 months. Google nearly doubled its revenue backlog to $468 billion in the first quarter, up from $243 billion in the prior quarter. 86% of all analysts have a buy rating on the stock. That doesn't mean much to me, but it tells me that if Joe's a broker at Goldman Sachs and Joe has 40 clients, he might go to his 40 clients and say, hey, we got a buy on this stock. You want it? JP Morgan already has a price target last week of 395 on the stock, but they upped it to 460 due to the stellar results. Alphabet's within striking distance of overtaking NVIDIA as the world's most valuable company. Google delivered a standout quarter with its full stack artificial intelligence approach driving accelerating growth, wrote JP Morgan. It remains our top overall pick. We believe shares will continue to go higher on both earnings revisions and multiple expansion. Google nearly doubled its revenue backlog to $468 billion in the first quarter from $243 billion. That's the single most impressive metric this earnings season thus far, so says the analyst at JP Morgan. Some other things to look at. The firm is also watching Google's sale of AI tensor processing units to cloud customers. The TPU work has been a success with hardware sales driving a big share of that cloud backlog. DA Davidson Gill Luria wrote in a research note last week, the cost and mechanics of these TPU deals remain a question, however. Following strong earnings print, DA Davidson was one of the few dissenters on Wall Street, reiterated a neutral rating on Alphabet. Luria boosted his price target from 310 to 375, but said Google's outperformance is well reflected in current valuation. Next up in the world of AI, XAI turns Grok into a cheaper, louder, more everywhere type of model. Grok 4.3, a new reasoning model aimed at coding, logic, math, scientific work, and agentic tool use. Analysis says the model improved XAI's intelligence index score while cutting input and output pricing versus Grok 4.2. VentureBeat framed the launch as both a model release and a pricing move, with XAI also pushing a new voice cloning suite. The voice side is where the product direction gets a little bit more interesting in my mind. XAI's homepage is now promoting custom voices and the voice library, while the company's Imagine API is being built around native audio generation for video. The pitch is not just better chat, it's AI that talks, clones voices, generates media, and starts to bleed into consumer interfaces. It's a weird thought that my kids could get an AI agent and I can post all my letters that I've written to them through the years and my advice on investing through podcast, and they could have a dad AI. Long after I'm dead, giving them advice on what type of stocks I like and why I look for total addressable market, why I look for revenue, why I look for management. I look for companies that I want to own for the next 20 years, no questions asked. That even though I like robotics, I think it's more of a play for NVIDIA than, say, SoftBank. That could all go into my Grok, and their AI agent could be like, Dad, I miss you. And it'll bring up one of the loving notes that I wrote. I used to write notes and put them in their lunchboxes for school every day, telling them how great they are, telling them how they make me happy, things along those lines. I got the idea because one woman I was reading about, she was a single mother and she put notes in her daughter's lunchbox every day. And the daughter grew up and published them. And I thought that was pretty cool. And it was things like when kids tease you at school, it's not because they don't like you, it's because they want to be you. And it got me teary back then. So I was like, that's the one idea I think I stole on parenting. When I had kids, a lot of people gave me books on parenting. I was like, don't want them. I want to learn how to do this myself. But that was one inspiration that I got. So if you're a new parent, consider it. It'll pay off for years to come. Tell them a story about when you were in second grade, things like that. SoftBank has mapped out a $100 billion robotics spinoff. SoftBank's unwieldy portfolio of AI investments is starting to feel a bit odd. So he's going to bundle a bouquet of existing SoftBank bets together into a new venture that exists at the intersection of AI and robotics. It's going to be called Rose AI, SoftBank. They have a leader, Masayoshi Son, that I feel he's very hit or miss. Just about everyone in AI world right now sees so-called physical AI as the next great frontier. It was all over the Consumer Electronics Show when NVIDIA CEO Jensen Huang famously declared that robots were about to have their Chat GPT moment. What was your Chat GPT moment? I have an Uber moment. I was at a friend's apartment in San Francisco, and we were getting ready to go out and see a show. And she called an Uber. And I was like, what's that? And she goes, oh, people in the city, we don't drive. We have someone else drive us. I'm like, that sounds expensive. And it wasn't, because they were trying to get pricing to get people hooked to the situation and to continue to use their product in the future. Anyway, so robots are a thing now. And I think that's one of the reasons why NVIDIA will see their stock move higher, because they own the software. They dominate software in all things AI, and it's a big moat around their business. And it promotes using their own semiconductors. So I don't really get what SoftBank is doing here. They have a very costly alliance with OpenAI, which looks to be a losing bet compared to Anthropic at this point in time. But tens of billions of dollars are tied up with OpenAI. I'm not saying OpenAI is going to fail, or that Grok's going to win, or that Anthropic is the dominant player in enterprise. They are. And that's part of it, but my wife still uses ChatGPT and OpenAI, and I hate it. Last month, SoftBank signed a $40 billion. Let me speak English. Last month, SoftBank signed a $40 billion bridge loan, its largest ever lending facility, denominated solely in dollars. SoftBank has considered selling its Intel stake to fund its investments. Last year, it sold $5.8 billion stake in NVIDIA. A little bit too soon. But when NVIDIA went sideways for 6 months, it showed you they're not totally stupid over at SoftBank. So robots running AI models created in data centers being used to build more data centers to train more AI models. SoftBank's interest in robots has ebbed and flowed through the years. They had built a robot dubbed Pepper. They canned that in 2021. They had Zoom Pizza. It was a robot-operated pizzeria startup. It shut down in 2023. Last year, they agreed to acquire ABB's robotics business, which builds bots for industrial settings, for $5.4 billion. So ABB will be the centerpiece for Rose, and we'll see in the near future. Let's end this segment, and I got one more segment after this on strategy. Ask Jeeves is shutting down because the company behind the internet's most iconic butler in the golden age, search engine Ask Jeeves, it was just never caught on. It caught on for moments. And they had commercials. Do you remember the butler Ask Jeeves? So he's hanging up his three-piece suit. He actually hung up his three-piece suit in 2005 when holding company IAC acquired Ask Jeeves and renamed it Ask.com. It's getting out of the search business and ceased operations, so says IAC. It did end with a sign-off, which is cute. Jeeves' spirit endures. Huh. It was at the height of the internet.com bubble. We had Google, we had Yahoo. We didn't need Ask Jeeves. We had Excite, we had Lycos. There's plenty of search engines. And now, what do we have? Google and Bing? Doesn't feel like there's much else. There is talk that AI will disrupt search, but so far, Google's saying, nope, that ain't the case. I have an event coming up May 16th, 12 days from now. Still have room. Can only fit 10. It's a Pints and Portfolio in San Mateo from 11 to 1. All by the beers. We'll talk financial planning. I'll bring a couple financial planners with me. For every 3 people that sign up, I bring one. And these are highly knowledgeable people that will tell you what you're doing right and wrong on your path to retirement. We'll give you a free preliminary plan after the event, which it's probably about 3 to 5 hours of workup by the financial planners to get your data and put it in and tell you about your mortgage and tell you about your product that you're doing well with retirement, product that you're not doing well, product that you should look into. It'll be worth your time. And it's absolutely free. And it's by some of the nicest people in the world, including my future financial planner, Julie. You can sign up for the event at robblackshow.com. That's robblackshow.com. One more segment coming up.
Don't want to work forever? Check out the Retirement Planning Guide on robblack.com. That's robblack.com, powered by EP Wealth.
I've been working since I was about 14 years old. My mother used to drive me to the mall to work at a job called the Enchanted Village, and I built Apple IIc's and Apple IIe's. And then later I got a job scooping ice cream for Baskin Robbins. But that was always about having a little extra money in high school to afford things like dates. But it also gave me a social skill to interact with people. I love working because you interact with people. That's what I try to tell my kids, even though that lesson isn't sinking too well. One of the things that I've learned through the years is that Americans are just terribly not ready to understand the mathematics of retirement. The average couple needs $315,000 in retirement. $315,000 for healthcare, not for travel, not for housing, not to meet women, not for a timeshare in Cabo Wabo, not for Disney and the grandkids, just for healthcare. That's insane. Americans underestimate their lifespans and they undersay. Only 1 in 3 Americans can correctly identify how long a 65-year-old will typically live. Most Americans don't see how long they're going to live in retirement, and it's sobering. Only half of workers who expect to live less than a decade in retirement save regularly. 26% of these save 5% or less of their annual salary. You should be saving 15% of your salary no matter what. My dad died really early, 58 years old. My mom died kind of late, 85. So where am I going to fall in that? On the flip side, more than 7 in 10 of those expecting to live 30 or more years in retirement save regularly. And 4 in 10 save more than 10% of their income each year. You should save 15%. But for those of you who have grandparents who lived to 80, 85, 90, 95, you're saving more, and you should save more because it's in your genetics that you're going to live longer. The thing that stinks here is there's no right answer. I'd rather you be conservative and not run out of money than you be aggressive and run out of money. I don't want to live with my kids in retirement. Therefore, I plan to have more than enough. I want my kids to live a good life. I want my kids not to worry about mom and dad. I want my kids to not worry about changing my diaper. Like, no. Reaching a 7-figure milestone was my big goal when I was 16 years old. I figured $1 million I could live till the day I die. And my silly thought was I could do it as a 35-year-old with the most beautiful woman on the planet. We could sell oranges and apples on the beach in San Diego. That was my retirement plan when I was 18 years old. Starting early, if you're 18 years old, $166 a month is $2,000 a year. That's a good start because that's, in 5 years, $10,000. 10,000 becomes 20, 20 becomes 40, 40 becomes 80, 80 becomes 160. That's a good seed amount to build a big acorn tree. By age 30, I want you to have 1 to 1.5 times your salary saved. By age 40, I want you to have 3 to 5 times your annual salary saved. By age 50, 6 to 10 times. By age 60, I want you to have 8 to 10 times, 8 to 12. If you can get 20 times your salary, you've done it. You probably will have enough to live till the day you die. These numbers aren't chiseled in stone. There's a lot of levers involved. There's a lot of tax planning involved. There's a lot of employee match involved. There's a lot of gap strategy as your career progresses and your income rises, maintaining your current lifestyle while directing 100% of your raises into investments, often called stealth saving. It's a fast way to accelerate your timeline on retirement planning. I think people tend to be too rigid with their long-term savings goals. They'll say, like, I need $1 million. I needed $1 million when I was 10 years old. And then you get married and you're like, oh, maybe I need $2 million. And then you have kids and you're like, okay, I got to raise a kid from 0 to 10. That's going to be $350,000 plus another $300,000 for college costs. So my number quickly went from 1 million to 2 million to 4 million plus. And then our lifestyle got into private schools. And suddenly I needed 10 million to be my magical number to retire. I've more than hit all of that. And I'm making mistakes that are conservative, not aggressive. I don't believe in rigidity. I think it's a big mistake when you approach retirement planning and financial issues. I think the American financial consciousness falls into $1 million is a lot of money, and I think it's a psychological trap. I had to redefine what is enough at least 4 times. If $1 million is a flawed target, what is enough? So I tend to go 10 to 20 times your salary is where you're aiming for. 20 if you're living in an expensive area, 10 times your salary if you're living in a lower cost of living area. But to be honest with you, let's go with 25 times. Let's err on the side. Let's leave some money to charity. Let's leave some money to like fun. I've got a bucket list that includes blowing $1 million in Vegas. I have that buffer. My psychological barriers to wealth are few and far between. I don't have a defeatist angle when it comes to investing or saving. I don't look at like this president or that president's good or bad. I don't look at that anyway. I look at capitalism and what it's done in the last 100 years. And I go with that on market investing. I don't fall into the middle class wealth trap. I was raised in the lower middle class, and to be honest with you, it's probably the best thing that ever happened to me. I don't have a need for an expensive car. I don't have a need for an expensive house. I have an expensive house, but I don't have an expensive car. And my kid wants me to get an expensive car, and I just won't do it. There's 3 phases of retirement spending, and I know this, and you should know this. 65 to 75, those are the go-go years. Those are the last periods of your life where you're going to be able to get on a plane, get in a hotel, fall asleep in a hotel, travel, and all the things that go with it, and see the world. Then there's the slow years, which is 75 to 85. Your spending's going to decline. Your physical activity is going to slow. That's when like living off 4% of your income is much more, or 4% of your assets for income is much more realistic. Then there's the no-go years where you're basically just ready to die at 85 plus. You're not going on vacation. Like you might be throwing down a little extra money on grandkids and stuff, but healthcare and long-term care costs, those are your big areas of spikes. If you ever want to talk about this, I want to talk about it. I'll take you to breakfast. I'll get lunch with you. I'll get coffee with you. I'll do a Pints and Portfolio. We'll grab a beer. Don't be afraid of this angle of wealth and this approach to financial planning. I'm living it myself. You can always find me online at robblackshow.com. That's robblackshow.com.
The markets are more volatile than ever. Inflation, interest rates, global uncertainty. If you have $500,000 or more invested, ignoring it could cost you your future. At EP Wealth Management, they offer a free preliminary financial plan, a chance to identify potential risks in your portfolio before the next downturn hits. Get insights from Chad Burton, CFP, and Rob Black, trusted voices in financial planning and retirement strategies. They'll help you spot hidden risks, rebalance thoughtfully, and uncover opportunities to grow and protect your wealth, even in turbulent times. Their goal? To help you feel more confident about your financial future during uncertain times. Don't wait for the markets to decide your future. Schedule your complimentary preliminary financial plan at robblackshow.com. That's robblackshow.com. EP Wealth Management. Plan smarter, live better, no matter what the markets do. Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.